I'm Nicola Sargeant, so I'm tax senior manager, actually based in our Forfar office. So we've travelled up today to, or up, with down, whichever way I've gone, I don't know. But yeah, just to give you a quick update, obviously there was a lot came out in the budget. Everyone wants to know about it. It's all I'm asked about on a daily basis. So I thought we'd give you a quick summary of what happened for those of you who aren't fully aware. So just a quick outline of what we're going to cover there. So jumping on, so capital gains tax. For me, as a tax advisor, I was quite shocked they didn't go higher with the capital gains tax rates. I actually thought we would have seen them aligned with income tax rates. It was rumoured, but it didn't happen. So for those selling property, it's such a bad budget. So we had a rate increase. Prior to the budget, the residential property higher rate limit, that was reduced in April from 28% down to 24%. So for gains on residential properties, we were seeing tax at 18% if you're in the basic rate or 24% if you're a higher rate taxpayer. Prior to that, we had a 10% rate for residential property, which is your farmland, buildings, things like that. But they jumped that up, so they've increased that in line with the residential rates, which is what this table is here on the right. So on budget day, it actually changed on budget day. So yeah, it wasn't as high as we thought, so not such a bad thing. One good relief, which we use a lot, again, I was surprised they didn't whip that away. They're still looking to help entrepreneurs, people selling businesses. So we have business asset disposal relief, which was formerly called entrepreneurs relief. Previously, that limit was 10 million. I think maybe I'm going to say 5 years ago, I might be wrong, but it did decrease from 10 million down to 1 million. So on the budget, again, we thought they might take that million away, they might reduce it, but they didn't. They kept the £1 million lifetime limit. But what they have done, it will give you a gain at 10% instead of the 18% and 24%. What they have done from April this year, that rate will increase to 14%, and then April the following year, it will increase to 18%. So whilst it's still there, they're slowly aligning it with the other capital gains tax rates. It is a valuable relief. I'm speaking to a few people at the moment who are selling farms. It's a tricky relief. It's not straightforward, depending on how your business is structured. If you're a sole trader or if you're a partnership, it's not always easy to get into the relief, depending on how the business is structured. So I would always say, if you are looking to sell a farm, take advice. At least probably I say at least 2 years, but sometimes we can change the ownership. If it's been owned for 2 years, you can get into the relief. So it's definitely worth speaking to us, because it is a huge tax saving. You can get up to £1 million each in lifetime. Anti-forestalling rules apply. That just means that it's trying to stop people who are benefiting from the lower rates putting unconditional contracts in place to try and benefit from the rules, which is very common when they have a rate change in budgets. Furnished holiday lets, for anyone that does have furnished holiday let property, you might be aware by now already, but that's been removed from April 25, so this April coming. Again, it's been a valuable relief for years. Income from furnished holiday lets qualifies for pension contributions. You can claim capital allowances, which you can't claim on a normal non-furnished holiday let. So all of these are being withdrawn. There's transitional measures to take into account anyone that has capital allowances they might have not already used, to allow them to continue to receive them. And again, if you're selling a furnished holiday let, you can get into that business asset disposal relief 10% rate. And so there's still time to plan for that as well. One thing, again, a surprise for me, was there were no changes to the gift holdover rules. What I thought might happen was they would pull that back, but they didn't do that, so we can still make gifts in lifetime and benefit from the holdover rates that we talked about. So talking about inheritance tax, I'm sure everyone in the room will be aware of the £1 million allowance. It attracts 100% relief, the first £1 million of your farm. That's whether it qualifies for agricultural property relief or business property relief. And then any value in excess of that 1 million will only get 50% relief. So a lot of people talk about a 20% IHT rate, but it's really, you're getting 50% relief. You're paying 40% tax, but you're getting 50% relief on the amount over the 1 million. So it's, again, yeah, so it's still, the way they're selling it is a 20% rate, but I don't really see it that way. So everyone has their nil rate band. That's your full relief up to the first 325,000 with no IHT. That remained, but it's remained frozen until 2030. I've not seen an increase in that for a long time now. The residence no rate band, so where the value of your estate before any relief, so that's before taking into account your agricultural property relief, business property relief, if that's less than 2 million, you can get into the residence no rate band, which gives you an extra 175,000. So it takes you up to £500,000 of no rate band. But once you go over the 2 million, that's withdrawn by £1 for every £2 that exceeds the 2 million. Another blow was for pensions. We saw them, but the rules are not changing on those until April 27. There has been a consultation put out to all professionals, which we've sort of responded to, and we're waiting to hear back from HMRC on how that will interact. The understanding at the moment is that the new rules apply from April 27. As at the moment, if you have a pension and the member dies before age 75, the beneficiaries inheriting that pension can withdraw the funds without any IHT, without any income tax. If they die after age 75, there will be an income tax charge based on that individual's sort of marginal tax rate. So if they already have other income, they could be paying higher rate tax than they might take out of the pension. So what we'll see come April 27 is that you will pay IHT on the value of the pot. And then if you want to withdraw it and the member has died after age 75, you'll have income tax still to pay on that. So this one here sort of gives an example. So here on the left, we have our sort of current rules. So we're taking a estate worth 2 million with 700,000 in a pension pot. At the moment, we're saying there's a no rate band of 650,000. This assumes this is on second death, so spouse has died with their no rate band available. It's passed on to the spouse. So there's 650,000 there relieved with no inheritance tax. The value of the estate, we ignore the pension at the moment. So the value of the estate is 2 million. So you're getting the benefit of that net residence no rate band. So the net tax payable is at the bottom there. So come April 27, what we need to do is we bring in the value of both the non-pension assets and your pension assets. So you've got an estate worth 2.7 million. This means on second death, that no rate band, because it's reduced by £1 for every £2 over 2 million, it's completely withdrawn. So we're losing that no rate band. What we also have to do is split the no rate band that was previously available on those non-pension assets. So that, in this case, could be your farm that's going to one member of the family. You could have the pension going to another child. They'll have to split that no rate band, the way the rules are written at the moment. So it means one child might end up paying potentially more inheritance tax on their share than what they were expecting previously. So it's probably about what we were saying, rethinking your wills, making sure that assets are going and that we're not having some paying more than expected. This example obviously assumes somebody's died post age 75, so we're saying there's income tax there as well. Because what we'll do is we'll take off the no rate band, you'll pay the inheritance tax on the difference, take off that 212 from your 700,000, you then pay the income tax on the net amount. So the income tax looks less, but you're actually paying inheritance tax as well. So if you look at the net amount you're receiving in your hand on that pension, it is a lot less than what it was previously. So jumping back to inheritance tax, I've got an example here. So this is probably similar to what we were talking about. It's a farming partnership. We have a husband and wife. They have a partnership which is worth 4 million, so 2 million each. It's jointly owned. They each own 50%. They also have other assets which are about £500,000 each. So total value of their estate here is 2.5 million. So under current rules, they'll get full relief on the value of their interest in the partnership. They'll have their 350,000 no rate band. So there would be some inheritance tax payable, but it would only be on 150,000, so quite a small amount. This assumes on first death, we're not taking the spouse transfer. It will pass to the children on first death. And what we're seeing here is an increase because we're only getting the first million at the 100%. We're seeing an increase of 200,000 on the estate on death. So huge increase in what it was previously. Normally on first death, the farm would go to the spouse to use up that spouse exemption that's there. But I think we need to rethink that now and look at maybe banking that £1 million allowance on first death, which is kind of what we're trying to illustrate there. Another point to note is this residence nil rate band. So the value of their estate is over the 2.35 million, and that's the point where we lose that residence nil rate band. So a couple of things to consider. How do we improve the position? Life insurance, a lot of people won't have that because the farm at the moment is fully covered by inheritance tax relief. So come April 26, that position will change. We're seeing examples of a farm worth, say, 5 million inheritance tax bill of £1 million. Some people will be at an age where they might not be able to get life cover, so that's where we need to think about, do we gift the farm on to the next generation? Ultimately, you're passing that issue on to the next generation. Somebody will always have that IHT burden, so they then need to think about life cover for themselves. You can get life cover where on a lifetime gift, in that 7-year period run-off that we talked about, where the gift still forms part of your estate on death if you die within 7 years. There's certain life cover that will cover that 7-year period, which can be less expensive. And think a partnership agreement, as Petra talked about this the table. I still can't believe how many partnerships I come across where we say, have you got a copy of the partnership agreement? Oh, we don't have a partnership agreement. And we've seen some really strange situations where there should be one. So if you don't have one, please think about getting one, speak to your lawyer, make sure you get one in place. It will determine who owns the property. Half the battle we have when we're advising clients is, who owns it? I think Dad owns it. Actually, you find out Dad had gifted half to the wife at some point over the years. So it's a big thing. We have to make sure we know who owns it, especially for inheritance tax purposes. Legal rights, we touched on that as well. If there's assets in a partnership, we have to think about other children that might not be farming and how that might impact on them. Spread that limit, think about the £1 million limit, but think about any earlier planning that's happened. I had one recently where, and just before budget, they made a gift before the budget. They're now thinking about passing it on to the next generation. We're saying, well, stop, don't do that. What you're going to do is upset the inheritance tax relief that you had on the earlier gift because of that 7-year run-off period. So think about things in the last 7 years. Don't jump ahead and start moving things around without thinking about that. Asset protection issues. It's easy for me to stand here and say it, but don't let tax, be the main thing that's the commercial. You've got to think about the commercial family needs. Do you want to continue to use the asset? If you give away your farmhouse, continue to live there. It's not necessarily out of your estate for inheritance tax purposes. And think about other taxes. So we're making gifts in lifetime. We have to think about if there's any debt over the property. Is the individual you're passing that asset on to taking that debt on? If there could be land and buildings transactions tax, which is your stamp duty. There could be that to pay, and there could also be capital gains tax to pay, because by taking on that debt, they could be effectively paying you for the asset in a way. Are you asking your child to pay for the asset? We might not get into the holdover relief. So there's lots of different things to think about. It's not just inheritance tax. And then lastly, just the gift with reservation. So if you're passing on the farm, you have to reduce your income to reflect that. You can't pass assets on and continue to enjoy them in the same way you would have previously. So continue to live in a house after you've given it away. There are ways around it. You can pay rent, but that might not necessarily be what you want to do, pay rent to the next generation. But it's just thinking about that as well. We might say keep the farmhouse in your own name, pass on the farmland. So there are ways around it. So just lastly, what's happening next? We have been speaking with our professional bodies, various stakeholders. We're sort of pushing back to HMRC. We've given them lots of examples of where we think the rules are really unfair. They talk about a £3 million farm not having any issue. We think there is an issue for inheritance tax because there's only a £1 million allowance. At the moment, that £1 million allowance is not transferable. So when, as I mentioned earlier, if a spouse dies, their nil rate band of £325,000 can pass on to the spouse. This £1 million allowance doesn't do that. You can't pass it between spouses, so it is a standalone allowance. is the £1 million enough? Sorry, is what we're trying to say. Yeah, we don't think it is. I've heard rumours that it might have been increased, but I think these are just rumours. We don't know. We do have a budget coming up in March, just near the end of March, so we'll see what happens there if we get any further input on it. Yeah, so increasing allowance, we would need it to be a lot higher. And like I say, on 6th of April, it's an overnight change. It goes from getting full relief on 5th of April to potentially half relief, just short of that on the next day. And thinking about the pension changes, we're pushing back on that as well, that the impact on the residence nil rate band, on the example that I've shown, where you can potentially lose that as well, just with the changes in the pensions.
Ladies and gentlemen, could you please put your hands together for our very knowledgeable family farms and the information they've given us?